What government shutdown? Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of January 22nd, 2018. I'm recording it here on Saturday, the 20th. And of course, Congress and the administration failed to come up with a budget and avoid deadline for a government shutdown. So the government is officially shut down. And I'm showing the S&P 500 chart as of the close Friday, and the market basically said, so what, with that shutdown looming, and now ultimately it happened. Well, the good news is I just saw a headline that here on Saturday that the president and the Senate Majority Leader Mitch McConnell are having a meeting this afternoon, so we should all feel better, right? Right. How long the shutdown will last, whether they'll come to terms even over the weekend or next week, we can't predict the future. But what we can do is look at historically how the market has responded to these government shutdowns. This is not the first one by any stretch. And I think the market, when you look at this chart, pretty much discounts these government shutdowns as positioning, maneuvering without any real lasting impact on the country, the economy, or the markets. But hey, let's take a quick look. This is really, really interesting information. So here is a chart showing the government shutdowns starting back in 1976. It shows the date it started, the date it ended, how long it lasted, and what happened to the S&P 500. It's also really interesting, who was the president, and was their party in power in the Senate and the House. Interesting data, but you can see historically the reaction hasn't been that big. 79, 4.4%. That's a pretty big move, but most of them are pretty muted. And interestingly, as we get farther out in time, closer to current times, even smaller and initially pretty much always negative, now not so much. And even with the shutdown, the latest one in 2013, market went up 3.1% during the 6-day shutdown in that period. So the current one, obviously this date is wrong. It is January 19th, 2018, and of course we don't know how long it will last or what the market reaction will be. But again, historically, the average response has been a negative 0.6, and the market has gone up almost half the time at 44.4%. So that's a pretty interesting chart. It doesn't predict the future, but it does give us some kind of probability of what has happened in the past with these government shutdowns. So there we have it, and probably not apocalyptic in terms of a response Monday morning at the market open if the government remains shut down for a few days. But if the government shutting down isn't going to slow down this incredible bull market, it's a fair question to ask ultimately, what will? We know that historically that all bull markets eventually end and correct, even if the market's going to continue up. So it's a reasonable question to say, what would cause the market to correct? So I found a pretty good article here on CNN Money. I'll put a link to it in the written version of this, so it's worth reading. It's pretty interesting. Of course, CNN always has to have talking heads and an autoplay video that you can't stop for quite a while. It's super annoying, but that's the price you have to pay, I guess, to read their article. But the title here is "The Stock Market's on Fire. What Could Possibly Go Wrong?" And they get into some pretty good analysis of some potential triggers that could cause the market to pull back, and they make the point here that I made, that stock market, bull markets don't last forever. So what could cause it to pull back? A bond market freak out like that. Ultimately, more increases in bond and interest rates, right? And making the investors long in the stock market, start to think about, hey, if we've been in this long run and it starts to pull back, now that yields are up on bonds, maybe we can move our money over there rather than risk the pullback in the market. So that could be a bond sell-off, and a rising interest rates could be Armageddon for stocks, they say, maybe. And again, inflation. If inflation takes off, that could force the Fed to act. Nothing would give Fed governors and the Fed chair cold sweats like inflation. That's one of their key measures, and they do not want to runaway inflation to happen on their watch. NAFTA trade collapsing, trade war breaking out. Sure, that could be North Korea, geopolitical shock, a growth shock, where the economic growth, the U.S. economy that's been surging and fueling the stock market rise to a large degree. If that slows, that could be a problem. Maybe nothing stops it and it becomes a speculative bubble. That's an interesting comment. So those are some things to watch for sure. And in talking about the Fed, next up on their schedule of when they will discuss future interest rate moves it's not very far away. So on January 30th, Tuesday, which is just over a week away, they begin their next meeting, and then on Wednesday the 31st, they're going to make their meeting announcement about any new information in the economy, their forecast, and any interest rate moves that they plan to be making. So that'll be a big deal. And again, just over a week away, not very far at all. So those are some good things to watch for. And I'm not sure if you would envy Jeremy Powell, who just got confirmed as the new Fed chair, here at the taking over at a pretty interesting time with the market at all-time highs and racing for the sky. You could either be the one who helped keep that going, or the collapse and all that stuff happened on your watch. I don't think I envy that job. But let's take a look at some other things that might be interesting. So with the current rate hikes that are already planned and announced, and maybe some more coming if the Fed sees some signs of inflation creeping out there and again giving them nightmares. TLT, the iShares 20-year plus Treasury bond ETF, typically moves in inverse relationship with rates. So bond funds value goes down as newer, higher priced bonds are issued. You start thinking about that too much, it'll make your head spin, but that is a reality. And we're looking for an entry here, a short entry on TLT. Want to see it get proven and put in a new low, and we see a big impulsive move down there, correction, and then potentially a move on TLT down below 113 into this target zone. And the technical analysis on the chart here seems to correspond pretty well with fundamental and just news about what's going on. We're not going to take a trade till it's confirmed. We want to see a good trigger on that, and then we'll be interested in going short on TLT. And of course, there's an inverse ETF available for this. It's the ultra short. It's TBT, and this one, of course, would be a long trade for those who are not able to short or don't like using options. So pretty much a corresponding move up in TBT. So those are interesting trades that we will be watching very closely and participating in if the final criteria is met. So that's a lot of information, a lot of things to watch for, and as always, it will never be dull. And if new information comes to light and changes things, we'll definitely issue a new timely report. Meanwhile, let's take a look at gold and oil. Gold's been interesting, been pretty volatile. Over last year, it put up a rally, nice impressive move up, pretty big correction, and then started up again. Seems to be failing a little bit, pulling back. We would need to see this pull back and then reverse to continue. So we're looking at a bit of a pullback here, probably down to about this purple line, about 1307 or above it. If it gets below that, then it might be breaking down. But we do think there's a bullish move on gold coming, and but it's volatile. You got to watch that closely. Expect a short-term pullback, a reversal, and then up to new highs, at least new highs for the last couple of years. So that's what we're watching for, but it is pretty volatile and not a sure thing. Oil. Look at the daily oil futures contract here. Oil's been on an absolute tear starting in summer of 17. Pretty big run, from $44 up to 64. That's 50% gain, pretty much, pretty close to 50% gain. Don't be surprised if we get a pullback in oil, even down to the Ichimoku Cloud, down to about $60. But we do think that rally will then resume and continue. That is the technical analysis here, and it becomes more clear on the weekly chart when we shift and we see that, after the big huge drop in oil from over $140 down to 40, that the retracement up to the mid 80s is probably what's happening here. On the weekly, it does encounter the 200 moving average. I'm not sure that's as relevant on the weekly chart as it is on the daily. So again, probably going to get a little pullback, normal higher high, higher low, higher high, higher low, but eventually over time reaching at least up into this mid 80s is what it looks like. All right, well, that's it for this week. Lots of things to watch, super interesting, and hey, we have no government services in theory, right? If you go read a little deeper, it's like, not that much is really being shut down. Again, it's a bit of showmanship and leverage and negotiating tactics on the part of politicians, and the market has pretty well discounted that in the past, as we saw. All right, take care, trade safe. As always, send me your questions, your comments, your feedback. Love to hear from you. Try to respond to every single one. We'll catch you on the next update. Thanks.